Good afternoon, traders. This is Chris Buss with Traders Profit Compass with a weekly look of the indexes and FATMAAN names, and I'll also throw in semiconductors as well. Hope you guys are enjoying the 3-day weekend, getting an extra day off today due to President's Day. But futures have been open and we're down significantly. I'm showing down about between 1.4 and 1.8% on the averages. With we'll have futures open tonight as well. So depending on how tonight goes, we could be looking at a gap down situation tomorrow morning when the regular session opens. So with the day off, I thought it'd be a good idea to take a look, zooming out to the weekly, to give us a picture of where we're at. So let's get into it. What I want to point out on all the charts, you'll see some common elements. One, in black, I have the Fibonacci retracement levels coming off of the COVID lows up to the most recent high. So you'll see that on all the charts. Also in green, I have the excuse me. Sorry about that. You'll see in green the 40-week moving average, and that has been a real good barometer of the trend on the weekly chart. So let's get into it. In SPY, we came off the COVID lows, working up into this narrowing wedge pattern to the most recent highs up near 475, and we've since dropped out of that. We had the initial leg down, then we put in a little bear flag, and we've since dropped out of that, and now we are below the 40-week moving average down here about 435. So as far as your trading goes, I think a real good barometer for you to follow on these charts when you're looking at things is, am I above or below the 40-week average? And that'll coincide very closely with the 200-day on your daily charts. And as you know, really the 200-day or the 40-week moving average, depending on what chart you're looking at, kind of defines whether you're on the right side or the wrong side of the chart. Once you lose the 200-day on the daily chart or the 40-week average on the weekly chart, that will put you into a, if you drop down below, then basically you're on the wrong side of the chart, and puts everything in a bearish tilt until that level can be recovered. So here we are on the weekly. We're below the 40-week. So intermediate term until that 40-week moving average can be recaptured. And I have it here at 438 and change, that the SPY is in a bearish posture. You can also see that RSI has dropped below our 50 line after being above it since back in 2020. This whole time it never dropped below 50, and now we're below. We've put in this little bear flag, and now we've broken. So if we just project this A, B, C move, I see that price could easily come down to 410, and then that'll be a really, really big level. Why? Because you see that there is another big void in the charts here below 410, where it could easily drop down into the high 300s down here at this first Fibonacci retracement at 375. And you say, wow, Chris, that's a big drop. And you know it is, but if you are a student of the Fibonacci retracements, a 38% retracement is very, very common. And if that level holds and then we start grinding back up, it'll just be a run-of-the-mill 38% retracement, and then we go. But until that time, you got to lean bearish on SPY as long as it's below the 40-week moving average, and until we find some level of support at lower levels. Now here on QQQ, we see the same type of thing. RSI below 50. We've got PPO diving at a very, fast rate. We've had bearish divergences in PPO for a long time. Now, what's a bearish divergence? Just to go over it, if you're not familiar with that term, it's when price is rising when momentum is falling. So in that situation, the buying intensity or momentum, if you will, is waning even as price is rising, and that sets up a vulnerable condition that potentially could lead to a trend change. And you can see here that we were rising in this wedge, and then we had quite a number of attempts at a new high up near 405. We dropped down below the wedge, and we've taken a quick move down, and just like SPY, we put in this little bounce over the last couple weeks and then have rolled over. You can see the 40-week average here contained those tries at a rally, and it has since rolled over. So you can also see in the volume over price profile that we're currently in a void in the charts. We've got the January low right here at about 330 that looks to be the next technical target. And if we were to break the January low, remember what we said, or always say that whenever you break a prior low, that's going to basically, from a psychological and financial point of view, anybody that bought this kickback rally is now going to be underwater, and it usually brings in more sellers. So if we cannot hold this January low at 330, I see us coming down to this 38% retracement level at 310, where I would expect a bounce. Why? Well, we're at a key Fibonacci level. We're also at a high, a large volume over price bar here, and we've got a lot of support in this area. So 310 will be a very, very, very important place on the chart for the Qs to hold, or else we go back into a void on support, and that would open up the door for a move down towards the low 280s, and the 50% retracement is down here at 283. So bearish posture there. Also on IWM, really the most bearish of the three major indexes. Why? You got RSI in the bearish regime. You've also got PPO momentum that has also moved into the bearish regime. We had a year-long consolidation here between about 210 and 230. We had the bull trap where we got a breakout, which brought a lot of people in, that was faded. Whenever you go back into a consolidation range after being outside it, your automatic default target is the bottom of the box. We found that. So leg down, bear flag, leg down, back test of the original breakdown, which again is very common. The fail, back test, fail. And now it looks like we're starting another leg down out of this little back test bear flag, and also well below the 40-week moving average. And the key level will be down at around 190 at the January lows. So that's going to be a really, really important level to hold. You can see we've got the 38% retracement level nearby, down at about 185. But other than that, you can see the big gap in the charts here, that if that level fails, there's really not going to be anybody home to save this from going from 190 down to 165, 170. There's just not any technical support there at all. So then you'd have a 50% retracement, and I would expect if it ever got that far that there would be a decent bounce there. But first things first, 190 at the January lows needs to hold. If not, potentially $5 less down here to this 38% level, maybe a level where it finds some support. But that will definitely be a key test for IWM. Moving on to Facebook. We all know about the big rug pull here a few weeks ago, and it has just let go since then. It's already blasted through all the potential Fibonacci retracement levels. It's already blown past a support level on these highs back here prior to, this is the pre-COVID high, down around 220, already well below that. I don't really think this is tradable here. I mean, the only way you could really do it is, go short with a stop just above and be prepared to be stopped out. But there's really nothing stopping this from going down to like 185, where you've got this large volume over price bar there as support, which is still, $20 less, $25 less than where it is right now. So very bearish look. I mean, we're oversold. We've got momentum diving. And I think what's going to happen is that if SPY and QQQ are going lower, I think it's going to be very tough for Facebook to, put in a rally independent of what the market's doing. And even if the selling intensity is less here because of the big rug pull already, I think price will probably just dribble lower over time if the Qs and SPY are heading lower. Apple has held up the best. I mean, it is the four-star general of the market, as it were. We've got this rising wedge. Price is still well within it. RSI still above 50. PPO still in the bullish regime. So currently, I think Apple is, the best of the best. And if you see this one starting to let go, you're going to see it in a lot of other places before that. Also, it's kind of hidden here, but the 40-week moving average is right on the line here of this lower trend line. So really, if this proceeds down, a big test will be holding like 155 in that area. So it would need to hold that, or it would open up the door to 145, and then potentially at this 38% level down at 132. So Apple, excuse me, Apple is still relatively strong compared to other charts. Tesla, same thing. I mean, it's been weak lately, but still, given the whole scope of the chart, relatively in good shape. It's dancing right here on the 40-week moving average. It has dropped below this weekly trend line. I think it's vulnerable here. It's hard to see, but the 38% retracement is at 785, and then the 50% retracement is all the way down at 648. So Tesla really needs to hold the 40-week moving average and get back above this trend line to stop the bleeding. You can see the RSI is just dipping down below 50, but we've been there before and it's recovered. So you know, I mean, there's still the potential that it can hold it here, but notice the big bearish divergence on momentum. And again, this was driving higher while momentum was fading. So I think Tesla will go along with whatever the broader market is doing. And one saving grace is there's been a lot of trading down in this area between, let's call it 550 and 750. And you've got a large volume over price bar here at 648. So if it does come down and get to this 50% level down at 650, I'd expect a bounce there. Microsoft looks very much like a lot of the other names. Multiple tries here to get above, to make all-time highs above 345. Was unable to do that over the course of a month and a half. Took the first leg down, put in a little bear flag, and now it's rolling over. It lost this big volume over price area at 290 and is also below the 40-week moving average that comes in at 295. So really, again, as far as trading goes, I'd like to see for a bullish setup, number one, to recapture 290, and number two, to recapture the 40-week moving average at 295. Otherwise, it's got a void in the charts here that could bring this down to 260 in a heartbeat, 260, 265. And the thing is, this doesn't look like a lot, but in terms of dollars it is, because the chart has gotten so compressed on this big run up that, you know, this represents, you know, a $30 drop. And if you're long, you just don't want to sit through that. So, you know, if you were caught up in this and you were still long, I would, you know, if price cannot recover 290 here quickly, I'd get out of that position and look to recalibrate at lower levels. So that one, you know, below trend, below the 40, definitely in a bearish posture. Same thing with Amazon. We spent a year toggling between 2,900 and 3,500. We had two fake breakouts that proved to be bull traps, putting in a double top high. Notice that RSI has been fading the whole time. Momentum has been fading the whole time. We had a quick move down from 3,700 all the way down to 2,700. So that was, you know, 1,000 points on that move. We had a strong kickback rally that brought it all the way up to 3,300, but now it looks like we're heading down, and it looks like below 3,100 is definitely going to keep it bearish. And we've got the 38% retracement level completely aligned with the bottom of the trading range at 2,900. What I would do on Amazon is, you know, unless you're a sharpshooter and are really familiar with it, don't mess with Amazon here. Let it get to 2,900 and then watch and see what happens. A break below 2,900 would really open the door to these January lows back here at 2,700. And then what my expectation would be, if it came all the way back down there, it would, I would say more than likely, go ahead and come down here to this, you know, 24, 25 area, 2,400 area for a 50% fib retracement. But more importantly, remember, this trading range went from 2,900 to 3,500. That's $600. And remember what we always say, when you break out of a trading range, the target is the width of the range. So your technical target is going to be 2,300. $600 range from 2,900 puts you back at 2,300. And that roughly aligns with this 50% retracement and this 2,400 level. And also, I think that'll be a big read on the market overall. Now, if it can hold 2,900, that'll be, you know, relatively bullish if it can hold the line there. And also remember, if you're trying to play Amazon and the options are just too expensive and volatile for you, you can go over to the XLY Spider ETF, consumer discretionary, and Amazon is 25% of that index on a cap weighted basis. So if you get a break of 2,900, you could jump over to XLY and put a short on there, and I can guarantee you, if, you know, Amazon is going to come off $200 or $300 or $600, that you're going to see that in XLY as well. Jumping over to Google, looks a lot like Microsoft in the sense that worked up in the wedge, spent a month trying to break out, couldn't do it, had the initial breakdown. We got a strong back test of the high where it got rejected again, and now we're sitting on this $2,600 level and below the 40-week moving average. So from a technical standpoint, it's in a bearish posture. We do have the January low down here at about 24.75, give or take, but there's also a void in the charts here, and you can see that the larger volume over price bars come in at this 38% retracement level at 22.55. So your first trigger is a break of 2,600. Your second trigger is a loss of the January lows, and then your target will be down here at this 2255 level at the 38% retracement level. Moving on to Netflix. I was surprised. I couldn't remember, and I don't follow Netflix all that closely, but the prior low happened before the COVID low, which is right here. The prior low had occurred back in 2019, back in the fall, and from there we went up and spent a year consolidating in this $100 range. We got the breakout, and then we got the measured move up to the top near 700. I think it got to 690, something like that. And then it just let go. And so we had a big leg down here. We had a kickback rally, but now price has faded. And what I do here is don't do anything with it. I would put an alarm at 375 just as a as a heads up. We still have the January lows, which were down here at 350. So if you got a break of 375, it's going to open the door to 350 and actually probably a lot more. And then what we're looking at here is, since we've already gone through all the retracement levels, we'd be looking at a round trip all the way back down into the 260 range if this low can't hold here at 350. You can see that's where the large volume over price bar is, and once you move below that, then you've got a big void in the charts here where price could move pretty darn fast when you move into these voids like we would have below 350. Lastly, semiconductors. We have been working higher in this rising channel, and like all the other charts that we've looked at, spent a month trying to break out here above 315, wasn't able to do it, and then we got slammed down about a month ago, and we had put in several rally tries, but notice that on every occasion of these rally attempts, price closed the week below the trend line. So that makes that trend line even more important from the standpoint it has been tested 4 times, and 4 times it has closed below trend. So as we sit here today at 265, we've got the prior low down here at around is right around 250. I think what's going to happen is this bear flag is going to play out for a move back to the January lows, and if that isn't able to hold, then we've got the 38% retracement level at 232, and then we've kind of got the last stop on the train here at 225, and then if that doesn't hold, we've got a massive hole in the charts here as far as technical support structures. And even if you didn't do any of this, even if you didn't trade any of this, have an alarm at 225, because I mean, if it loses 225, it's gone. It's going to be very hard to hold it in this area, even with the fib retracement levels and such like that. There's just not a lot of support down there to hold it up. So on the bullish side, if this can put in a weekly close above 275, 280 and recapture this trend line, that would definitely be bullish. But for now, I think that the path of least resistance is lower, and I think we're going to come down to test these January lows down here at 250 and potentially down to 245, where we've got technical support. Now, those are all the charts that I have for you, but I just want to kind of reiterate where we're at. The market is facing a shrinking liquidity pool, right? Ever since COVID, they threw trillions in monetary support and all the bond buying and all that stuff, in the trillions of dollars, and also the fiscal support, the helicopter money that went out to everybody. That was just, a bonanza, especially for businesses. All that's fading. And now we're in a regime where the Fed is going to be tightening. This is the last month where they're going to be buying. They just got a couple of weeks left to get into March, and then that's going to go away. And then we're going to get our first rate increase, whether it's 25 basis points or 50. It really doesn't matter. It's the mark of a rate tightening cycle, and that's going to pull liquidity out of the market. So that's a regime that we have not seen really since, the fall of 2018, where the Fed, remember, Jerome Powell said, we're on autopilot now, and the market went down 20% in 3 weeks, down to that Christmas low, and then January 4th, he reversed course, and then we went up again. Time will tell where that Fed put is, but I think it's much lower than people expect it to be. I think their prime objective at this point is to put the brakes on inflation, and they're not going to stop until they get signs of that being under control. So that pool of liquidity is going to be shrinking, and I think that's going to be very tough on the market. Now, if you've been with me a while, I've been bullish on commodities, been bullish on the material sector, basically long the real world, and long gold, as a matter of fact, as well. But the thing to remember is that even commodity-based stocks, they're stocks, and 75% of a stock's direction is going to be tied to what direction the broad market is going. So even though they may outperform on a relative basis, that doesn't mean that they can't go down as well. So I'm fairly concerned about the longs that I have in that area. If the market is going to proceed lower, then those longs may be misplaced, even though they're going down less than your bubble tech and your Ponzi tech and all the things that we've talked about over the last several weeks and even months. So we're just going to have to wait and see. But right now, I think at the very least, I've shown you that the market is very, very vulnerable here. And the reason why, if you're a visitor to the channel, first of all, welcome. But I spend most of the time on the indexes and FATMAAN names because FATMAAN is the market. So if you've got bearish postures across the board, semis and, all the FATMAAN names, it's math. I mean, they are 50% of QQQ, and they're, 30, 35% of SPY, if those 7 names are going down, then SPY and QQQ are definitely going to be going down. So we'll just have to, we play it day to day, some of us hour to hour or even less. But big picture, remember, the longer the time frame, the more important the signal and technical analysis. An hourly chart is more important than a 5-minute chart. A daily chart is more important than an hourly chart, and a weekly chart is more important than all of them. So if on our intermediate longer term time frame these weekly charts are breaking down, then we can only assume that the daily charts will be going lower as well. So we'll have to see where support comes in, and then we'll take it from there. But and I also wanted to point out, all the headline risks that we have with the Ukraine, that's going to play out the way it's going to play out. I think that's a secondary story compared to what the Fed is doing and what's happening in the real economy. So if everybody brings out the white flags and there's a truce or whatever, I have no doubt that there'll be somewhat of a pop. But I think what the Fed is doing is going to override whatever pop that we get. And if you see a rally that heads into overhead resistance that stalls or begins to fail, I would certainly be looking to fade any, Ukrainian bounce. And I think the real test for gold will be how it handles the Ukrainian situation, how much of this pop is geopolitical, and how much is the fact that, real rates are declining. And that's the headline rate minus the inflation rate. Those have been heading lower, and usually gold does well in a declining real rate environment. So we'll take that one day at a time as well. So if you are new to the channel, welcome. Thanks for spending some time with me. If you appreciate technical analysis and can appreciate being having a game plan set up, these are names that I go over every single day with the group and lay out objective trades on the daily and hourly time frames each and every morning. If you appreciate that, please hit the subscribe button and the alarm bell and hit that post notification alert, and you'll get all my YouTube content. And also jump over in the show notes and you'll see a place where you can, there's a link to the blog site where you can drop in your email address and get all my content morning, noon, or night right in your email box. You won't have to look for it. It'd be great to have you. And you'll also get an invite to our trading room where you'll find a lot of motivated, aspiring traders who have nice camaraderie, very helpful to one another, not only with ideas, but when one of us are having a bad day, we lift them up and we celebrate together on the wins and help each other when things are tough. So we'd love to have you if you're interested in that. I think you'd get a lot out of it. So enjoy the rest of your 3-day weekend, and we'll pick it up next time. This has been Chris Buss with Traders Profit Compass. Talk to you soon.